The U.S. stock market is now closed for the weekend. Opendoor Technologies, ticker OPEN, finished Friday's session in spectacular fashion, closing at 797. That was a staggering 13.37% gain on the day, an explosive move higher that came on the back of truly massive trading volume, with over 207 million shares changing hands. This price action caps a volatile week and continues a wild ride for a stock that has traded from just over 50 cents to nearly $11 in the past year. The immediate narrative, the one everyone is talking about, is that this surge was a sympathy play. News hit Friday suggesting inflationary pressures might be easing, which immediately sent investors scrambling for anything sensitive to interest rates. The expectation is simple. If the Federal Reserve is forced to cut rates sooner than expected, the mortgage market gets a lifeline, and companies like Opendoor, which are at the epicenter of the real estate market, get to breathe again. This is the story, this is the hope, but this is also a dangerous oversimplification. The reality of what's happening under the hood at Opendoor is far more complicated and, frankly, more precarious than a simple bet on rate cuts. The company is in the middle of a strategic pivot that is a matter of pure survival, and its stock has become a high-stakes battleground for some of the biggest and smallest players in the market. Most investors still see Opendoor as the quintessential iBuyer, a company that buys homes with cash, holds them as inventory, and tries to resell them for a small profit. This is the model that almost bankrupted it when the housing market turned in 2022 and 2023. They were caught holding tens of thousands of homes at peak prices, forced to liquidate them for staggering losses. The market has, correctly, priced this stock as an entity that could go to zero if that macro environment persists. That's the common ground, the shared fear. But here is the challenge to that thinking. Opendoor isn't just sitting there waiting for rate cuts to save its old broken business. The company's recent earnings report from August for its second quarter told a completely different story. For the first time in 3 years, they posted a quarter of adjusted EBITDA profitability. It was a small profit, just $23 million, but it was a signal that their painful, costly inventory clearout was largely complete and their new, more disciplined approach was taking hold. But that's where the good news hit a wall. In that same report, management guided for the third quarter, the one they're about to report on November 6th, to be a return to losses. They projected revenue to fall sequentially and for adjusted EBITDA to swing back to a loss of between $21 and $28 million. This is the core tension. Investors are bidding the stock up on the hope of future rate cuts, while the company's own guidance points to a difficult present. The Friday rally was pure macro optimism, but it flies in the face of the company's specific fundamentals we're about to get in just a couple of weeks. This upcoming earnings call is one of the most significant in the company's history. Will they beat that negative guidance? Will they show that their new, more asset-light model, which focuses on partnerships with agents and acting more like a marketplace, is actually gaining traction? Or will they confirm that they are still fundamentally a cash-burning machine at the mercy of mortgage rates? This tension is precisely why the stock is a magnet for short sellers. The latest available data from mid-October is stunning. 161 million shares are held short. That is a massive 27.4% of the entire public float. Nearly 3 out of every 10 shares available for trading are betting on the price to go down. This is one of the most heavily shorted stocks in the entire market. The thesis for these shorts is clear and logical. They believe the Q2 profitability was a fluke, a temporary blip from selling off old inventory. They see the negative Q3 guidance. They see the $789 million in unrestricted cash, and they are betting that the company's cash burn rate will accelerate again, forcing it into a dilutive capital raise, or worse, insolvency long before any potential Fed rate cuts can meaningfully boost the housing market. They look at the 4,500 homes still on the balance sheet, valued at $1.5 billion, and see it not as an asset, but as a ticking time bomb of liability in an uncertain price environment. Now, here's where it gets really interesting for retail investors trying to navigate this. When you see a 27% short interest, your first thought might be short squeeze, but you have to look deeper. The borrow fee rate, the cost to borrow shares to short them, is incredibly low, at less than 1%. This is not what you see in a typical frantic squeeze. This suggests the short positions are large, stable, and held by institutions that have easy access to shares. The days to cover is also very low, under 0.5, because the trading volume has been astronomically high. This isn't a simple, compressed spring. This is a deep, entrenched institutional war. Adding to the drama, we've seen significant fails-to-deliver spikes in recent months, with millions of shares failing to settle on certain days in September. This is a signal that retail investors on forums like Reddit and X are watching closely, often interpreting it as a sign of market stress or manipulative shorting tactics. What's your take on the rising short interest? Smart money or manipulation? To understand this battle, you have to look at who is on what side. The most recent institutional filings from mid-year show a fascinating and stark divide. The giants, the passive index funds, are fleeing. The Vanguard Group cut its position by 23%, selling almost 20 million shares. BlackRock cut its stake by a breathtaking 70%. This tells you their models see Opendoor as a high-risk liability, and they are de-risking. But at the same time, a completely different type of institution is piling in. Highly quantitative active hedge funds are taking the other side. Two Sigma, Cube Research, and Weiss Asset Management all established massive new positions. Goldman Sachs and UBS aggressively added to their stakes. This is the definition of a battleground stock. The passive, long-term giants are out, while the fast-moving active traders are in, betting on volatility and a potential turnaround. And perhaps most notably, Jane Street Group, one of the world's largest market makers, recently disclosed a passive stake of 44 million shares. This is not a group that makes idle bets. So what does Opendoor actually do now? For years, it was the iBuyer. Homeowners would go to their website, get a cash offer in 24 hours, and sell their home directly to Opendoor, avoiding the hassle of listings, showings, and repairs. Opendoor would then do minor fix-ups and try to flip the house on the market for a profit. It was a model built for a low-interest rate appreciating housing market. When that market flipped, the model collapsed. Today, under CEO Carrie Wheeler, the company is desperately trying to pivot. It's moving from a single product to a distributed platform. In plain English, they want to be a marketplace, not just a home flipper. They are building tools for real estate agents to use, offering cash-backed offers, and trying to monetize the millions of seller leads they get without having to buy every single house. This is the asset-light model. The entire bull case for Opendoor's survival rests on whether this new model can generate profits before the company's $789 million cash pile runs out. The future outlook then presents two wildly different paths. The bull case is that the worst is over. The company survived the inventory purge, it has enough cash to get through the winter, and Friday's rally is the start of a macro tailwind. If the Fed does signal cuts in 2026 and mortgage rates ease, the housing market will unfreeze. In this scenario, Opendoor's newly disciplined iBuying combined with its growing asset-light marketplace could finally achieve sustainable profitability, and the stock could retest its old highs. The bears, however, see a company in a death spiral. They see the 27% short interest as the smart money, pointing out the obvious. The Q3 guidance is negative, cash burn is the real story, and any rate cuts are too far away to save a company that is fundamentally flawed. They believe the stock is a value trap and that the recent pops are nothing more than short-term, meme stock-style volatility before the inevitable crash. As an investor, what you're watching for next is simple. First, all eyes are on that November 6th earnings report. The numbers themselves, revenue, adjusted EBITDA, and contribution margin, will be critical. But even more important will be the guidance for the fourth quarter and their commentary on the cash burn rate. Second, you must watch the macro data. Every inflation report, every Federal Reserve meeting, every new print on 30-year mortgage rates will send this stock flying or send it tumbling. Comment below with your price target for Open by the end of 2026. This is not a stock for the faint of heart. It is a binary bet on survival and adaptation. The expectation, fueled by Friday's rally, is that a rate cut-led housing recovery will lift all boats. The reality is that Opendoor is a specific, deeply troubled ship in that harbor, fighting its own battle against high short interest, dwindling cash, and a business model it is being forced to reinvent in real time. The coming weeks will determine if it's a survivor or a relic.